Hey everyone, how you doing today? This is Bradley Walters for Doc W Trades. I am streaming on a Friday, May 8th, 2026, and I'm just I've been busy all day. Haven't got much work done because where I live, the air show is going on. They have the air show this weekend, so all the jets have been out and about throughout the day. They started around just before 11 o'clock, and it looks like they're done for the day. But I'm going to stream for the next hour or so and record and everything. And so if there's some jets flying around in the background, you hear some jets flying around in the background. I'm not in somewhere in or close to Iran. I am in the United States of America, but so those jets are, if they fly around over the next hour or so, it's because of the air show. So, anyways, I do have a story. As I'm about to tell this story, we can take a look at the screen here. And if you look to the left, on the watch list, I do have my regular watch list that I use here, where the regular Doc W watch list that I use, and I also have another one I call quote board, where I do have the major indices. If we take a look at this watch list, we have the major indices, the S&P futures, which you can see here on the chart here, intraday chart here, for the S&P 500 futures. And this watch list has all these major tickers. You can take a look at the NASDAQ futures. Take a look here. It is getting closer and closer to 30,000 on the NASDAQ futures. So we're 29,000, almost 29,300 on the NASDAQ futures. We go down and take a look at the Russell 2000 futures, which is the best index. The Russell 2000 is the best gauge of looking at the entire market as a whole, because it's equal cap weighted, and there's 2,000 names in the Russell 2000. So this is the best way of looking at the general market as a whole. And as you can see, it's trading up today. We take a look at the Dow. The Dow is the I don't really pay attention to it that much. The Dow is price weighted, meaning that you only look at, it only shows it's most influenced. That's the term. Most influenced by stocks with the highest price in the index. Second of all, it doesn't have like 100 stocks like the NASDAQ 100, or 500 stocks like the S&P, or 2,000 stocks in the Russell. There's only 30, and they're price weighted. That means the stocks that are highest price, not market cap weighted, not equal cap weighted. The stocks with the highest price carry the most weight of the index. So that's why with the Dow, you can get a stock like United Healthcare, and it could have bad earnings, or really great earnings, or bad news, or really great news, and the stock can fly up or down because of this news or this earnings or whatever. And you're like, the Dow is not acting like the other indices. And the reason why is because a high-priced stock in the index is moving the index up or down too much. And usually that happens with United Healthcare. Because if we take a look at that stock, because it's in the Dow, we take a look at UNH, it's it's $374 a share. So these high price stocks have the most impact on the Dow. So the Dow is it's an old-fashioned index. It's been around the longest. It was created by Dow Jones in the early 1900s. That's why there's only 30 stocks in it, and it's just never been corrected to the times of the other indices. So we go through these other main indices on my quote board watch list. We have, I like to look at the bonds, okay? But if you don't want to look at the bonds, you can always look at, scroll down here, we can take a look at the actual interest rates. Okay, we can take a look at the bonds, we can take a look at interest rates down here, as you see here. But this is the bonds, and for those not familiar with the bond market, as the price of bonds move higher, the interest rate tied to it goes down, and vice versa. When the interest rate goes up, the underlying bond price goes down. So this is the 30-year bond price. Okay, we can take a look at the 30-year interest rate tied to it. As you can see here, it's getting kind of spooky right now, because if we look at the interest rate yesterday and the day before, we actually traded above 5%. And the way the Chicago Board Options Exchange quotes everything, a 50 is equal to 5%. And so at 49.42, that's equal to 4.94%. And the 30-year, this is the interest rate that's far out in the future. It's at 5, it was at over 5%, which is very, very high relative to where it's been. Let's zoom out a little bit here. And let's take a look at the 1-year daily chart on the 30-year. You can see here, we were over 5% about a year ago, but recently we've come back down. Came back down to under 4.5%, and that was, everything was looking good. It was like, okay, we got down to 4.5%. Hopefully, we get to 4%, 3.7%. But just recently, since late October, we've just been trending higher. Now, we had a nice little move down in February, but we're back up as the war in Iran has intensified, and as we jump to another symbol, as crude oil has spiked higher, specifically, we started to move higher in early February, actually late January. I want to say late January. We started to actually move higher, but we really started moving higher in late February. And as crude oil has been moving up, and then it pulled back, and now it's spiked up again, now it's pulled back, the 30-year, this is the 30-year bond, has been moving inversely to crude oil. And it has come down, then spiked up, and come back down again, as the basically the exact opposite to crude oil. And conversely, the 30-year interest rate has been moving up along with crude oil. So basically, all this means is that the market, even though stocks have stopped selling off and have been running up higher, the bond market and the interest rate market is still being affected by crude oil prices, because basically the market is saying that the longer that crude oil stays at an elevated level, the more likely that those high oil prices are going to have a trickle down effect in the system, in the economy, and create inflation that is going to put the Federal Reserve in a situation where they're going to have to raise interest rates. And what's interesting about all this is that you have this new Fed chair, Kevin Warsh, that's about to begin the Fed chair, and he has stated publicly that he is in favor of cutting interest rates. But the problem is, if you look at the markets are saying that the Fed, at this point, right now, as I speak, the markets are saying that it is not likely that the Federal Reserve is going to cut interest rates. Now you take it to the next level, next dynamic. A lot of people say, oh, well, you don't need to cut interest rates. We got the markets at all-time highs, and AI is booming the economy, and everybody has a job, and they have a second job, and maybe a third job. But they don't understand this other dynamic that President Trump understands, that the Treasury Secretary Scott Bessent understands, and the new Fed chair Kevin Warsh understands. That we have this overarching problem that you have all this debt in the system, and right now the debt to GDP ratio, people say, oh yeah, debt's at all-time highs. That, it's by itself is not a problem. The problem is your debt to GDP ratio. The debt to GDP ratio for the United States is getting higher and higher and higher. If you look at history, it was at very low levels, about 50% of GDP. 50, 60% of GDP, and we ran a budget surplus in the early 2000s. Now, we look at other countries like Japan, their debt to GDP ratio is, above 200%. So you can make the argument that having a high debt to GDP ratio, specifically above 100%, it's not such a bad thing. Ideally, you want it below 100%, because just like a business, if my debt is above the amount of income that I have, there's a risk that I won't be able to pay it off. Well, if a country's gross domestic product is equal to the amount of debt, as long as it's at 100% or lower, it'll eventually be able to pay it off. After it gets above 100%, there's that risk that we can't necessarily pay off that debt. But then you look at Japan, they have a debt to GDP ratio of over 200%. Everything's fine, nothing's happening so far. So you take it to the next level. One person who is a historian and an economist that I have a high respect for, because he's a historian and an economist. His name is Neil Ferguson. He wrote that wonderful book, The Ascent of Money. The book is about that thick, but you don't have to read the whole book. You can read through it fast, and then you can go on YouTube and find videos, video summaries of the book. So you can do both, or a little bit of both, and learn a lot about how money came about, how money works, and it helps you understand crypto better. But anyways, that is Neil Ferguson. And what he said is, he makes the argument, he's been on many podcasts talking about this, is that when a country's in when a country's annual debt exceeds their defense spending, that is usually when an empire reaches the point of saturation and then starts to decline. Every time in the past, throughout the past hundreds of years, thousands of years, when the budget for the defense bill is higher than the amount of interest on the debt. That's it. The annual interest that a country pays, the annual interest that a country pays for 1 year on their debt exceeds the defense budget for that year. When that number goes higher than the annual defense spend for that country, that means that the empire is at saturation and usually is going to go into decline. And we are at that point where the annual spend that the United States has to pay on the deficit, on the debt, is getting higher and higher and higher and higher. We're at that point where we're risking where the defense spend is going to be much lower than the annual interest on that debt, and that is a huge problem. And Neil Ferguson talks about this. He emphasizes this issue, and the Trump administration, the Treasury Secretary Scott Bessent, and I'm sure Kevin Warsh, the new Fed chair, understands this very well. Yes, you have issues and risk of inflation with higher oil prices, for sure. But that debt, that interest that we have to pay on that debt, the higher interest rates are, the more we're going to have to pay on that debt, the more interest we're going to have to pay on that debt. And we need to get these interest rates as low as possible, because the problems that can come up in the future, if these interest rates stay higher than they need to be, can cause big problems for us as a country and an empire in the future. And that is why the argument where, we have to make sure that we don't have inflation and we got to keep interest rates at elevated levels because the economy's chugging along and AI spend is fantastic and everybody has a job and everything's going great. Well, that's all true. But the situation is we also have this interest bill that the government has to pay. And we don't want these interest rates to just skyrocket higher over time. And we need to really watch out for these interest payments and the interest rate on these interest payments to make sure that it doesn't get out of control. And you look at this 30-year Treasury bond interest rate at 4.9%, and that's pretty high. We need to get that closer to 4%. And as we were going into 2026, it was looking good. We were getting towards 4.5%, and the idea that we could get towards 4% was starting to be something that we considered. Even after this little pop higher at the very end of the year, we came back down towards 4.6% of the 30-year. But since the pop in oil, interest rates have gone straight up higher, and we just got above 5% just a few sessions ago. Then we take a look at we scroll down the watch list, and we look at the 10-year bond. So the bond market for the 10-year interest rate is, it was having a nice rally higher, going higher, but then we started making lower highs. Then we popped up and made new highs on the 10-year bond, which was great. But since the start of the war, we've just been falling lower and lower, and we are just trending lower for the 10-year Treasury note. And as a result, scroll down and take a look at the 10-year interest rate. It's at 43.62. That's 4.36%, and it has been rallying, ever since the start of the war. At the beginning of this year, at the end of last year, and early on this year, we were testing the 4% level, and that was fantastic for the 10-year. We were looking at the hopes of going towards 3.5% or 3% was really in the cards. It was an idea that was talked about, but ever since the start of the war, the 10-year has just been creeping up. It got back above 4%. It's held that 4% level very well, and now it's at 4.3%. And there's a lot of hopes and dreams that a lot of talk that Kevin Warsh could cut interest rates, and that would subsequently push the interest rates like the 30-year and the 10-year lower, but they haven't been moving lower. They've been moving up along with crude oil that is moving higher. Let's go back and take a look at crude oil just to keep everything in perspective, so everything makes sense. Interest rates going up, bonds going down, interest rates, crude oil going up, and this idea that inflation is going to come into the system because crude oil prices are going to be elevated seems like an overall theme in the market that is sticking around and lasting as this war in Iran continues and the Strait of Hormuz issues persist. Now, all that being said, one of the commentators on CNBC, Steve Leisman, said, "Listen, I'm in the camp that Kevin Warsh could actually end up cutting interest rates, even though it's not priced into the market." Now, that all said, what does Steve Leisman say when he says it's not priced into the market? Obviously, we go back to the interest rates. The interest rates are elevated, and they were pushing towards towards being below 4% on the 10-year, and now we're at 4.3%. So the interest rates are rising. That's saying that's the market saying that we're not going to get a rate cut. But there's also a website, and I've been able to hook up my system so I can show you guys this stuff, called Fed. I'm just going to type into Google Fed Watch Tool. Okay. So you can just type that into Google, and it comes up first result on Google from the CME group. Okay, right here, the CME group. It says Fed Watch. You can click this, and what this is this shows the probabilities. It's kind of like prediction markets, and it shows the probabilities of what is what the Fed's going to do in the future. So it's very similar to prediction markets. It's just that these probabilities come from a separate market that trades options from the Chicago Mercantile Exchange. So, and these markets constantly change, just like prediction markets too. So it's interesting. Just type in Fed Watch Tool in Google, and it comes up. So we take a look here. We have the next meeting for the Fed. That's the 17th of June here. And we have the current rate, which is 3.5 to 3.75. And we look at this rate, 3.5 to 3.75, and it has a 93.9% chance that it's going to be at 3.5%. at the next meeting. That means there's going to be no rate cut for the next meeting, and the odds are it's that about 94%. So let's go out. Let's have some fun. Let's go out and take a look at other meetings. So this June 17th meeting is evidently going to be the first Fed meeting, if all goes as planned, with Kevin Warsh as the Fed chair. So it looks like at this point, there's a 94% chance that there's going to be no change, and there's a 6% chance that there will be a rate cut. So let's go out in time. Let's hop into our time machine. And remember, the current Fed rate right now is 3.5%. 3.5%. So go out to time. It's 87, almost 88% chance of 3.5%. So in July, the market is saying that there's an 88% chance that there is no rate cut. Okay, let's go further out in time. Let's go out to September. 87.2% chance, 3.5 to 3.75. That's where we are right now. So the market's saying an 87% chance that we don't get a rate cut by September. I don't know. October, 81% chance that we don't get a rate cut. Here's the crazy thing. There's actually at this point close to 7% chance factored in that we actually get a interest rate hike. Now there's 11% chance that we get a cut, but there's a 7% chance by the October meeting that we actually get a hike. And these are live odds based on the option market from the Fed funds futures, traded on the Chicago Mercantile Exchange. So this is even more accurate than the prediction markets, because you have so much liquidity and so many people trading these markets. Now, I'm going to stop this and then bring up this board here. I'm going to go down, scroll down here. See this symbol ZQK26? That is the Fed funds futures. And this market, basically, the way it's quoted is pretty interesting. So I'm going to pull this up and we're going to go to the trade tab. It's 30-day Fed funds futures, and that's traded at the Chicago Mercantile Exchange. And basically, the way it's quoted is you take 100 and subtract, so you take 100 and subtract the number here, 96.36. Now you take that number, okay, 100 minus, the way they come up with this stuff is just, it's specifically to make people's heads explode. But you take 100 minus that number that is quoted right here, and this is the active contract, 96.35, 90. So it's quoted. So you always take 100, no matter what, and you subtract the price here, the last price traded. You have the bid and you have the ask, and look at the size. 275,000 contracts traded today. 275,000 contracts offered, at the bid, and 20,000 contracts at the ask. And you look at these contract sizes traded, 67,000, 52,000, 51,000. It's very liquid. But you take that 100 price and you subtract it by the last price, which is 96.365, and you get 3.63, which is, we pull up the Fed funds futures, right where the current rate is. Okay, it's just quoted in that weird way where you have to subtract 100 from whatever the price is of the Fed funds futures. Now we go back to the Fed fund futures, and you see this is like all priced out over all these expirations. And as you can see, there's very big liquidity going all the way out to like May 27. So it's a very active market, and there's options here. Now there's no options market, there's no options traded here, but I think there's another market that trades options. Yes, it's SR. So this is the ZQ. This is the 30-day Fed funds futures. There's another market called the ZR, the SOFR rate, and this is more liquid. Okay, this is even more liquid. This market, this is 3-month SOFR futures, and this market is even more liquid than the 30-day Fed funds futures. And these contracts are very liquid. You see here, 2,000 by 2,500, so 2,400 by 2,500, 15,000 by 626,000 contracts. You go out, you have 36,000 contracts traded, 211,000 contracts traded, 289,000 contracts traded. And then you look at these options, they actually trade options on these. And the delta of these options and the expiration of these options goes into the probabilities of these rates. So the market is telling us what the probabilities of what the Fed's going to do. Very complex, very mind-numbing, but the SOFR futures, and the SOFR options give us a probability of what the rates are going to do in the future. So we go out to October, and we have 81% probability that the Fed is just going to stay right where it is. And we go out to December, and we say, oh wow, there's actually a 14% chance that they hike by 25 basis points. And we can hear the jets in the background. There's a 10% probability of a 25 basis point cut, and a 74% chance that they just keep rates where they are. We go out to January 2027, and still there's a probability that we hike and there's a probability that we cut, but the probability that we hike is 18%. That we're going to be 25 basis points higher. And there's close to a 70% probability that the Fed just leaves the rates where they are. So the market, this idea that we were going to cut rates very aggressively with this new Fed chair named Kevin Warsh, it's not necessarily lining up the way the market saw it before, because of the risk of inflation, because of higher rates, or higher rates are up because of the risk of inflation. And that is the situation that is happening now because of higher oil prices and this risk with oil, and the closure of the Strait of Hormuz and inflation trickling through the system because of higher rates, and this war possibly going on and on and on. Now, the Stanley Druckenmiller in me, okay, the gambler in me, if I was running a big macro hedge fund, I look at these probabilities and I say 18% chance of a hike, 70% chance of no hike, and no cut, going out to January 2027. The Stanley Druckenmiller in me, who says, listen, we may be in a situation here where we have a new Fed chair who is possibly Donald Trump's personal sock puppet. That's what the Senate was asking Kevin Warsh during this Financial Service Committee hearing. They're like, are you going to be Donald Trump's personal sock puppet? He's like, no, I'm not. I'm going to be an independent Fed chair. But my point is that like you look at the market, you look at everything the way it is right now. You have a new Fed chair. You have Donald Trump as president that wants rates cut. Okay, that's evident. You have this war in Iran. You have the Strait of Hormuz that's open one day, then it's closed the next. I don't know, depending on what news service you read. And the markets are saying that there's this risk of inflation because this situation that we're in is going to continue. When you look at these probabilities, what the market is saying is that the current situation, there's about a 70% chance going out for the rest of 2026 that this current situation will continue with only a 10% chance of rate cuts and an 18% chance or 19% chance of rate hikes. Like I said, the Stanley Druckenmiller in me says, well, that's what the market thinks now. But what if the world changes? What if the world is different in 7 months than it is today? What if they cut a deal and the war ends and they open up the Strait of Hormuz and oil collapses and inflation doesn't get into the system and they have to cut rates? Can that happen? Maybe it can, maybe it can't. It's probably a 50-50 bet. But you look at this probability graph, and the market's saying there's only a 10% chance of that happening. I think that's a good bet. I think that's a great bet. So if I was running a macro hedge fund, like a Stanley Druckenmiller or Paul Tudor Jones type of thing, and Paul Tudor Jones was on CNBC a couple of days ago. You should look at the interview on CNBC. I would bet big on this. That there's actually going to be rate cuts, because I think deep down, Kevin Warsh wants to cut. I agree with Steve Leisman, but he's got to convince the committee, and he's got to get through he's got to get confirmed. He's got to then get maybe a couple meetings under his belt. He's got to gain some trust. He's got to convince the committee, and then he needs something to happen that's constructive on the interest rate front, and he can easily cut rates. That's my bet. Even though the market says that's not going to happen right now, I can easily see these probabilities going to the left over the next 5 or 6 months. Now, how do you bet on that just as a simple retail trader? If I was a macro hedge fund manager, I would buy bonds. I would go, and we're going to go away from the 3-month SOFR futures, and we'll go and take a look at bonds. I would look at Treasury notes and Treasury bonds, and I'd buy these. Sorry, wrong button there. I would buy these. I would buy these 10-year Treasury bonds. That's how I would do it. And Treasury bonds going up is also, and interest rates going down is also what? It's very bullish for stocks. So just buying stocks on its own, I think is also a good bet. And you have, on top of that, you have the whole issue with supply demand for memory chips, for GPUs, for CPUs, for storage. I just got done listening to CoreWeave CEO. They had earnings last night. He's talking about how, I haven't heard any other people mention this, but that's why I like to listen to a lot of companies' earnings calls. He said, well, it's not just memory, it's not just GPUs, it's not just CPUs, it's also storage that we're short of. So all that high demand for AI they continue to build out the AI infrastructure. The earnings this cycle have been fantastic for all tech, all AI companies. So this idea that you can still have tech and AI get built out, and you can still possibly have inflation go down over the next 6 months. It's not a outcome that I don't think Wall Street is betting on, but I think it's possibly could happen. You know, right now, you know, we're Wall Street is looking for a 19% increase this year in earnings, and you know, the S&P is traded at about a 22 multiple. That seems about right. So I think that we can just you know, to have strong earnings for 2026, and interest rates actually go down as inflation goes down. That's I think it's possible. And the thing is that if we go back, this is turning into a long and precarious conversation, but if we go back and take a look at the interest rates, we look at the 10-year at 4.3%. Okay, let's take a look. Let's go to the chart tab here. We look at the 10-year at 4.3%. The CPI is right around 2.8 to 2.9 to 3%. So the 10-year interest rate should be closer to at 3% or lower, not at 4.3%. So I have to bet that you know it's crazy, but that's my thinking. That tech stocks go up, the AI infrastructure build out continues, earnings continue to grow, the demand continues to grow as inferencing continues to grow and agentic AI continues to grow, and we get closer to robotics, which is a whole other thing. Okay, and that's a whole other can of worms that the market hasn't priced in yet. It's still down the road, but when it comes, just Katie bar the door. That's all I want to say. In the AI story, and all this tech build out is actually deflationary. Huh? Is that possible? Yeah. And inflation goes down. There's some type of truce with the war in Iran, and it ends, or there's some type of truce between Iran and the United States. The Strait of Hormuz opens, oil goes down, interest rates go down. I think that could all happen by go back to the other screen, by 27th of January 2027. Do you think that there is a higher probability of 9.6% chance that happens? And I think the answer is yes. So if I was in a macro fund, I would be buying treasury bonds, and I would be buying the Qs, and I would be buying the SMH index funds. But for an individual trader, I don't know if buying bonds is the best thing. I would be looking for individual AI stocks to look to make money on. So this watch list, we go in full circle. We go with this watch list that I went through, goes through the main quotes, the main tickers. We went through some major symbols, and you can take a look at a couple other symbols, and before we go on to the other watch list that I wanted to show everyone. Let's take a look at, we already looked at crude oil. Let's take a look at gold. Gold is basically just gone into a sideways range recently. It had its huge climactic move higher, and this was obviously a buy climax here at the end of January, and we have just gone into a range contraction phase where we basically have had back and forth sideways action. We bounced off of the initial buy climax, made a lower high, which in hindsight constituted the end of the uptrend, and confirmed the fact that we were going to go into a sideways range, and that's exactly what we've been doing back and forth. Sold off and undercut that big sell-off from the end of January, and we're just bouncing around this 4,700 level. Anyways, silver, same story. Had a buy climax, reversal, and now back and forth sideways range ever since then, right around the happy place at the $80 level. And I have some main stocks on this watch list and some other stuff that I like to look at. Like I showed you guys, interest rates and some other stuff, some other commodities as well. But as I said before, if I was a macro investor, I would buy bonds looking for interest rates, bonds or treasury notes looking for interest rates to fall closer to where inflation is at 3%. As an individual investor to continue to push the AI theme, and if we get interest rates to drop like I'm expecting by the end of 2026, that's going to be very bullish for stocks. Very bullish for stocks. Because I think that this move up in stocks is not so much to deal with the war or interest rates or inflation or anything like that. What this move higher in stocks has been tailored to, from a fundamental point of view, is higher than expected, better than expected earnings on all the tech stocks. And I still don't think that the Wall Street establishment as a whole, the Wall Street professional establishment as a whole, really understands what's going on with this AI boom. So all that said, this is the new watch list that I created, this YouTube live watch list. It's basically over 180 stocks, and I tried to put in all the good quality, fundamental, high volume, highly active at stocks that have good fundamentals and good theses on this watch list. I'm going to make a broad, complete watch list of all the stocks that I look at and scan. And this watch list, it has 182 stocks at the moment. Going forward, it can contract, it can get smaller, it can get bigger, but it will have about, it may only have sometimes maybe 100 stocks on the list, but it may get to as big as 250 names on the list. And it's basically all the quality stocks that come up on my scans when I do research. And I can, going forward, just scroll down and look at names that stick out to me and give my analysis. And with that said, I wanted to, before we start going through these stocks one by one, I wanted to talk about a little story. I was, this week I went down to Miami to this event hosted by Morgan Stanley. Oh my God! I just said their name. Oh, I was not gonna uh, say the name of the firm on my YouTube channel. Uh-oh, I may get in trouble. Anyways, and there was a lot of very stuck up, snooty people. I mean, it was pretty crazy. Some of the people there, I mean, they live in a whole other world. This, like, to see multiple people, with shoes that cost more than $3,000, and then you know suits that cost like more than $10,000 or $15,000. It was just crazy, and I'm like, this is nuts. I'm there with shoes that cost like $80, and there are people there that literally had shoes that cost in the thousands. It's suits that cost over 10,000. Absolutely nuts. They live in a whole different world. But what I wanted to find out was how do they go about trading and investing? Like, what are they looking at? Are they going through each stock one by one, looking at the fundamentals and stuff? And the answer is, yeah, they have people that are analysts that work for them to do that. But they have like models and stuff. I don't think they're listening to every single stock conference call and looking at every single stock's fundamental value and so on and so forth to make decisions. They're much more using models and so forth, and using AI to help them do research and analysis. They're not taking the time to dig into an individual company to find out what's going on. It may be, and they're focused on stuff like private equity and stuff because that's a very inefficient market, and they can find a lot more opportunities doing stuff like that than using models to find discounted cash flow probabilities with stocks and so forth. And they kind of looked down on me because I was the active trader of the group, and I wasn't, in a wealth management client. I was just some deranged trading junkie. And one guy was like, I told him that I make like 5, 10, 15, 20 trades a day. He's like, what, really? And then he was even more like shaken up when I told him that I get 15, 20, 25% a year returns. He's like, how is that possible? Just trading stocks? I'm like, yeah, and options. Yeah. He couldn't believe it. And he actually, the representative of me had to say, like, no, he gets decent, solid, consistent returns. Like, he doesn't get 25% every year, but he gets 20, 25, 15%. He has a year where he's flat. He had another year where he was down, but he's pretty consistent. He really grows his account. And the guy was like, yeah, how is this possible? His head was like spinning. You could see his eyes like darting back and forth. He's got like waxed teeth. He's got waxed teeth. And he had like a toupee that was like, it wasn't a whole toupee. I've never seen anything like this. So it was like a toupee of a toupee. So the toupee was like fitted to his waxed teeth head, and his head was about to explode. His ego was so huge. But the toupee like left a little bald spot on his head so it looked real. Really interesting. I've never seen anything like that. But these people, man, my buddy who is a professional, worked in the business, he goes, no, that's how they are. And their heads are huge. They look down at retail investors like you, me. They don't think that we can really do this because the answer is they gave me the stats and the data. Most retail investors don't make money. Most retail investors, within a year, they're gone. They lose money. So specifically active retail investors. And that's just how it is. They said, make sure that you don't try to like monetize and like put too much effort into your YouTube channel because like most of the people just can't do this stuff. And they said, like, keep trading, keep doing what you're doing. You know, what you do is very special and unique. Uh, but don't put it, like, keep your YouTube channel as a hobby, because these people can't do, you know, what you're trying to teach them. And I'm like, okay. And right now it is a hobby because I'm not monetizing this. I'm not selling subscriptions or anything. And, you know, we'll see how it goes. But with all that said, I am streaming and recording because I do like to do this, and I want to help people. And but I'm not trying to. I'm treating this as a hobby. I will take their advice on that, and not monetize, not rush to monetize this. And you know, quite frankly, I can make money in the market. I don't need to, but I want to help people. So, anyways, I've been jabbering on for an hour about stuff, and I haven't not gotten to a single stock yet. Whew. So, with all that said, we still have an hour left in the trading day. So, let's go through some stocks. I'm gonna take a look at. Let's take a look at a. Let's load a style. I'm gonna look at this here. What style do I want? These are all chart templates that I've built. What do I want to look at? I wanted to look at. This is the RSI. RSI chart template. So let's start out. What stock pops off the screen? Let's take a look at Tesla today. Tesla is having a huge gamma squeeze. We take a look at Tesla here. And it has had a nice gamma squeeze to the upside today. And we can see how we got a nice nice buy divergence in the RSI here, and the stock has turned and burned since the beginning of April, along with everything else, and it is trading to the upside. And we look at the intraday chart here, and we can see how Tesla is having a nice move up and has been traded sideways through most of the day. Now we go back to this daily chart here. Let's see something here. Okay, this is another chart of Tesla. Hold on. That's a weekly chart. It's a daily chart. Okay, that's what I want to look at. This is a better chart. Okay, here we go. So let's take a look at Tesla here. And we see here I have I have Keltner channels loaded up here, which is just like Bollinger Bands, but that uses average true range. It doesn't move up and down as much. I think it's cleaner and nicer. I've switched to Keltner channels because it's cleaner and nicer. It doesn't mean I won't look at Bollinger Bands. It's just like, something different. And you can see here a nice move up in the rate of change. We have a move up in the slow line, and now we have up in the fast line. And now Tesla is above the upper Keltner channel, which is very good, which means we can continue to go higher. The only thing is that these momentum indicators, the fast line and the rate of change, it's a clear divergence. So you have a clear divergence on the fast line and the rate of change. Now that doesn't mean that Tesla can't go higher. It just means that it's running out of momentum, and you have to be aware that the big move has already happened. The momentum thrust already happened, and now we're above the Keltner channels, and now we're running higher, and now the momentum is declining. Now, the key here is the slow line continues to have an upward trend. The fact that the slow line has an upward trend in the daily chart means that even though you have a sell divergence, it means that with the stock above the upper Keltner channels, the sell divergence in the fast line and the rate of change, the stock is moving up, the stock is extended, the stock is in an extended run, but momentum is falling. So it can continue to go higher, but the easy money has been made. Because if we go back in time, when we were down here and we started moving up, we made new momentum highs, which basically preceded this move that we're seeing now. It can still make another up move higher, but that up move higher may be a lower high. We may get a dip and then another up move higher, another swing higher. It may take out this high or make a new high, or not. But that high may be the last high before we go into some sideways consolidation. But the overall trend, the overall move as a whole that we could say started in April, is and can continue as long as the slow line continues to trend higher. Now, let's take a look at the Tesla intraday chart. And I'm going to change the style here. What template do I want to look at here? Okay, that's a 1 minute chart of Tesla. You can see here very clearly here on this intraday chart, each bar is 1 minute. You see how we gapped up higher? We had a nice move up into the close, which is very impressive. And that's very bullish. You have that big up move into the close, then you gap up higher. We had a nice move up into the 10 o'clock hour. You had your dip at the 10 a.m. hour. That was your buying opportunity if you didn't get in at the beginning. And then we pushed up into the middle of the day, and then we have this sideways range. What you want to see as we go into the closing bell, and we have less than an hour until the closing bell, you want to see a push up into the close to indicate that we're going to continue to move up next week. So let's take a look at the Tesla trade tab, trade tab for Tesla. We'll look at the options. We go down to option statistics, and we have over 2.5 million contracts traded on Tesla. Huge numbers compared to 1.5 million puts. We have the put call ratio at 0.6%, so it's very bullish. And we look at the percentage of trades here, and you can see that the majority of the options, you have equal number of puts to calls. You have a lot of puts being bought, that's 34%. You have a lot of less number of calls being bought. You have about a very equal number of puts being sold. Equal number of calls being sold. So it's very equal. This morning, I looked at it because this morning it was very clear that Tesla was getting some type of gamma squeeze, and they were buying lots and lots of calls. But as the day has gone on, and Tesla's leveled out, that gamma squeeze is over, and you look at the option statistics, it's pretty even. 42% to 33% traded in the mid, 34%, a good number of puts being bought, but also a good number of puts being sold, and a okay number of calls being bought. So what happened was, as the day went on, Tesla, the number of calls being bought has really dropped down, and that gamma squeeze happened early in the morning, and it kind of died off. at around the 10:30 a.m. hour. So let's take a look at other stuff, other things that's going on here. Let's other names that pop off the screen. Remember, I can scroll up and down, up and down, up and down. They got 182 symbols here. There it is, Intel. Let's take a look at it. Intel had earnings a while ago, about over a week ago, I think, and it is just getting gamma squeezed. And you can see that clear move into Intel. First off, right off of the opening bell, a big move up and into the 10 a.m. hour. Then a back and forth kind of reaction to the downside, and then another big move after the 12:30 hour. So you get this lunchtime chop, and then you get this other huge move in Intel. Bam! So I love it when you get an initial move off the opening bell, but then you get a second move, and that is all fantastic. And this stock is not just on the 1 minute chart. So you have a big move today, but you take a look at the daily chart. I mean, this is just a huge move higher. Classic squeeze higher. And what's interesting is you got one thrust up in momentum, you get new momentum highs, but then you get a gap up and a second thrust up in the stock, and guess what? Another momentum high. What does that mean? That means any pullback is a buy and it can go higher. I'm sorry to say it for the bears, but you have the upper Keltner channel that could be a buy point. You have the 20-day that could be a buy point. Any pullback, just be ready to buy it. Have it on your watch list. Keep an eye on it. It's extended now. You don't necessarily want to buy it right now, but you get it like a down day or 2 down days in a row, buy it, man. Because you have new momentum highs in the oscillators on the fast line, on the fast line, on the rate of change, and the slow line is still in an uptrend. This stock can keep going up as long as this slow line continues to trend up like this. Once it flattens out and starts to dip, and you have the stock going higher, then you got to be worried. And you get like multiple divergences on the indicators. Then you have on the fast line. So you get those multiple divergences that happen and stick, and then you have the slow line turn over like this. Turn over and flatten out and turn over. Then you have the up move running its course. But the fact that you have this high in the momentum and that high in the momentum, it's still below this high in the momentum, but another up day, you can easily get this to go back to new highs. It's starting to form a divergence here in the rate of change, and that's just natural because momentum precedes price. And if you get a pullback, or when you get a pullback, and it shows that this fast line is never made a new high, then that opens the door for the next up thrust to be some type of divergence and to be the final divergence before we sell off. But that hasn't happened yet because everything, this looks good. We're getting very close to where this fast line is pushing up to new highs, and the slow line's trending higher. So everything looks good, and you can easily get this fast line or this rate of change to pop up in the next day or two as Intel continues to go higher. So all it's saying is that we're due for a down move on Intel, and we're extended, but the up move can continue, and any dip, any pullback, any down day is a buy. Let's take a look at, let me see, we're moving up into the close, which is very good. Let's see here, let's see what else is going on. It looks interesting. It's one of my favorite names, Bloom. It was down earlier today, man. It was pissing me off. I was like, oh my gosh, Bloom Energy is selling off. It was due to sell off. It was extended, but and I had some calls on it, but that are expiring worthless today. But it has reversed and is going higher, which is great. Take a look at the daily chart. We've pulled back with holding above the 20-day, and you get starting to get some divergences here. This is not necessarily constructive. So we have new highs in the stock. We have a definite divergence here in the rate of change, and what makes that divergence in the rate of change stick and meaningful is that even though we're bouncing back and holding the 20-day, we're up below the 0 line. So the momentum has shifted to the downside, even though the stock is in an uptrend and going higher. And the fast line is now below the 0 line. Okay, that means basically that first you had momentum make highs, momentum preceded price to the upside. Now we're below the upper Keltner channel. We're holding the 20-day moving average. We're in an uptrend. At this point, everything's fine, and we can continue to go higher. But basically, this move that began here in April, you're now going into your last leg. And what confirms all that is that you have the rate of change negative. You have the fast line now negative. And guess what? The slow line is turned down. So basically, we can push up and make new highs, but if we get to new highs or we retest these highs in Bloom Energy, that is a sell for the short term. And what's about to happen sooner rather than later is at some point as we head into June, July period, we are going to go into some corrective action. Now, does that mean Bloom Energy is going to crash? No, I'm not saying that. I'm saying that we have had a period where we went higher, and then we had a period here where we went lower, and then a period where we went higher, then a period where we went lower. Okay. Range expansion, range contraction, range expansion, range contraction, range expansion, range contraction. And that is coming soon. The uptrend, the range expansion is coming to an end, and we're about to go to a range contraction correction phase, and that will last probably until the slow line gets below 0 and then has some type of divergence. And when that forms a divergence, you also get a divergence in the fast line and the rate of change, and then they'll go back into the positive level. That will be the point to buy Bloom Energy again. But I'm holding the shares through this. A lot of momentum type of investors don't like to hold during these range contraction phases. But for me, my style is as long as I am bullish fundamentally, and that is the fundamentals as a whole, with earnings, sales, margins, all that fun stuff, but also the thesis. Can I explain why I like it to a 10-year-old? Which the answer is yes. I've had many videos where I've discussed why I love Bloom Energy. Those ideas that I can explain to a 10-year-old, that thesis of the demand and need for energy and how Bloom Energy is able to provide that to hyperscalers. That thesis is why I love Bloom Energy. But what the technicals are saying is that this current move up is can continue for a little longer, but the momentum is gone now. Okay, the momentum is gone. So since momentum precedes price, any up move is probably the later stages of this move. And a corrective phase is now higher probability. So let's go on to some more charts. All right, let's take a look at this list. It's a big list, 182 names. Broadcom's up almost 4%. Micron's up 14%. You know, Micron, this is big, man. We had a big gap up today, move higher. Everybody on all these conference calls, they're talking about the need and supply shortage of memory and high bandwidth memory, and what I heard today from CoreWeave, now storage, which makes me more bullish long term on SanDisk, and I think that's why this stock is up 15%. Just thinking out loud. But let's take a look at Micron, then I'll look at SanDisk. Okay, Micron, as you see, this big move up continues all morning past that 10:30 hour where most stuff pulled back and kind of just chop, and then powered into the lunch hour. Had some lunchtime chop and is continuing higher. Fantastic. Let's take a look at the charts, technicals. And what we have here is we're very extended, highly above the Keltner channels. Continuing, and since we're that much above the upper Keltner channel, we're in an extended run higher, and we take a look at the oscillators. New highs on the rate of change, new highs on the fast line, and new highs on the slow line. And so any pullback is a buy in Micron. Let's take a look at the weekly chart. Same thing. We're just now testing highs on the weekly, on the slow line of the weekly, and new highs on the rate of change in the fast line of the weekly. What's interesting about this is that the slow line on this is really cool. The slow line of the daily chart is the fast line on the weekly chart. Now, what is really kind of interesting here is that the slow line is it's going up on the weekly, but not going up. It kind of dipped. we had a little trough. We had a little pullback, and now it's starting to go up. But I don't know if it's quite as high as it was. It's just at that level. So we need to see the slow line continue to go up and make new highs, which it may not as time goes on. So we'll see, and that may precede a back and forth sideways type of chop action. But for now, we're going to continue higher, I think. So, all that said, let's take a look at SanDisk. In CoreWeave on the earnings call, which I just listened to before I came on, where is SanDisk? There it is. Same story as Micron. Gap up higher and did a big thrust up like this. Very, very nice. And take a look at the indicators here. We have a high in the rate of change. Made a high just recently at rate of change, but today we are not. We're just below the high. So this is we're not making a new high in the rate of change. We're well above the upper Keltner channels. Super extended to the upside, and we're kind of coming down a little bit on the fast line. So the momentum is kind of waning a little bit in SanDisk, but nothing too concerning at this point, because we made a high before, and that high is playing out. That earlier high in momentum that we just recently made is is kind of playing out right now. What we want to see is that the next down day, it will be a buy, but it it may mean that momentum is kind of fading to the upside in CoreWeave. All that said, the longer term trend remains intact. Yes, we are gonna, as time goes on and we don't make new highs on the fast slide, basically the probability of a back and forth sideways chop action consolidation period is gonna happen in SanDisk, and the odds of a longer term trend continuing higher are very high right now as the slow line continues up. Let's take a look at the weekly chart. Same thing. Continue higher, and the rate of change is at highs here, and the fast line's at highs here. So everything looks very bullish on the weekly chart as well, but also super extended. So a big part of me yes, I'm bullish on a chart like SanDisk, but if it consolidates, if we have forms of divergences and we go into a consolidation phase and it comes down to 1,000, I mean, everybody's going to sell it. They're going to hate the stock, and I'm going to be like, oh my God, please, I want to buy it, because it's setting up for, after a consolidation phase, another run to the upside. But if you're a momentum guy, it may be tempting to hold on to this, but some of them like to take profits in this time, and others like to just hold it. I don't know. Depends on what type of investor you are, because it's just so extended. So let's take a look and see. Take a look at a couple other stocks. Sienna's up. Let's take a look at Palantir. And Palantir has just been getting whacked recently, and you see the intraday chart. It's just got sold off this morning, bounced back, and now it's at 136. But I want to take a look at the weekly chart here and the daily chart Palantir, and we've just been really in a chop range, and this is the Palantir is the exact opposite of what Micron and Micron and SanDisk are doing. Palantir is basically was in a fierce uptrend to the upside, and you see here on this weekly chart, fierce uptrend to the upside. Had a huge big year last year and basically peaked out right here in October. It has been in a consolidation sideways range. Now the stock isn't crashing, but it has been in a corrective state since October, and you see here how the slow line peaked in July on the weekly chart and started trending down in September or so, and we made a new high, but at that high the slow line was trending down, and the fast line formed a clear divergence, and that was the peak. Momentum precedes price, and we had another lower high in the price of the stock, and we have just been in a corrective phase ever since. Now, as this corrective phase has developed, we have the slow line starting to flatten out here, form a divergence. And the fast line has now come from being super negative to now being going, flirting to go into the positive territory. It's trying to, which is all very bullish. And you can say that that's a divergence. So it's very possible that, Palantir may continue for the short period back and forth, back and forth, back and forth. But then at a certain point in the future, you get a turn up into slow line, you get a push up in this, in the rate of change and the fast line into the positive. You get a buy in Palantir. And that, looking at the chart here, the 20-day right at 151, that is probably a good point to buy the stock based on the weekly chart. Now, let's take a look at the daily chart. And the daily chart, basically we have sold off, got positive, sold off, got positive. We got a nice divergence here in the fast line, and slow line is starting to trend higher, which is great. And the 20-day moving average on the daily chart is 141. So basically, like right around that 141 to 142 level, right just above where it is, that could be considered a buy point, looking for the stock to push up towards the upper Keltner channel or upper Bollinger Band. And that is where that early buy point is based, where the 20-day is on the weekly chart, where you can buy the stock. But if you want to get in even earlier, that 141 level is an aggressive buy point. But if you want to wait for the rate of change in the fast line to get into the positive, and that slow line to turn up into positive, getting in at 140 is that early entry. And then I think that 150 to 151 is an early entry in itself. And then above 160, you're going to start to get the momentum guys be interested in Palantir. But right now, when you have this much resistance to the upside, I don't think they're interested. I don't think they want to get in. But I like how, we're getting some divergences here. We got some divergences here on the daily chart, and we flirted with the positive, and the slow lights turn it up. So it's constructive. It's not the super bearish. And it had a huge run last year, so it needs some time to consolidate. And from a fundamental point of view, the multiple was so high in Palantir. That multiple needs to contract. So this sideways consolidation period has been very constructive, I think, and it may continue. We may go back and forth, back and forth, back and forth for a while, and then turn higher. So this may take more time for Palantir to work out its chart action. So that's Palantir. It had a huge multiple. It needs to contract. It needs to do some sideways consolidation in the stock. But I'm still very, very bullish on Palantir long term. I'm not selling my shares. So let's continue here. I've been yapping for over an hour and a half now. So let's take a look at AMD. Up 9% today. So it's in a gamma squeeze today. And I completely missed this thesis, but this is a great example of being a retail investor and how you get your real edge as a retail investor. OpenClaw came out, Claude came out, and it was talked about across the media landscape. Podcast, conference calls, even in the mainstream media, that you have this new thing called OpenClaw. And for it to run properly, you have to, people are vibe coding and all this stuff, making artificial intelligence porn. To do all this stuff, you have to buy a separate computer. Okay? You have to buy a separate computer. And you could have found all this stuff out by listening to Joe Rogan. Okay? You didn't have to listen to to listen to like all these like Dylan Patel, who's like this guy that like works at an artificial intelligence company. I mean, you can find this stuff out listening to Joe Rogan or Theo Vaughn, for example. It was out there. And people came on and talked about how you had to get another computer and then use that to Claude Code. Lex Friedman, that's another example. He was talking about this stuff, and all his guests were talking about this stuff. He had people like Mark Andreessen talking about this stuff, and so you have to get another computer to vibe code and use this Claude Code and OpenClaw. And if you take a step back and think about it, it was very evident that the dynamic was people are vibe coding, people are using this new AI models, and they have to get another computer to get this stuff working. And what did they do? They bought CPUs. And that showed up this quarter in the AMD conference call, in earnings report. If you, as an individual retail investor, took that and said, okay, I've listened to 3 or 4 podcasts. They're all talking about OpenClaw and Codex from OpenAI and Claude Code. They're all vibe coding. They're all buying other computers. They're buying separate computers. Well, if they're going to be buying all these computers, then that means they're going to have to buy AMD chips. They're going to have to buy Intel chips. And bam, these stocks are flying. I don't think there was anyone that explicitly said, oh, I got to buy another computer with AMD or Intel chips, so I should buy that stock. You have to have a certain type of mindset where you deduce stuff. You kind of think in a certain way. You have to have this thought resonating in the back of your mind where if you hear something interesting or compelling, you have to ask yourself, okay, so what does that mean for a stock? What does that mean for the market? Is there anything there that I can buy or take advantage of? And you're never going to get everything. This is something that I completely missed, but it was something that was a really real, tangible trade that made a lot of money. If you bought calls or stock in Intel and AMD in the past 3 or 4 months, you made a lot of money. Okay? And it's something that I don't think the average Wall Street investment banker with waxed teeth and $3,000 shoes and $10,000 suits and a custom-made toupee is going to get, because he's so focused on schmoozing, boozing clients, using his AI models to analyze stocks and private equity. And they really think that it's impossible to make money in the stock market as a retail investor. I really got that feel because they don't get this. They really don't. But you as an individual investor can kind of find that out. And here's the thing. This is my point. The fact that a stock like AMD, because the market is so efficient, and I do think it is efficient most of the time. There are tons of efficiencies most of the time in the market. The market has priced in most stuff. But this example that I just gave with buying chips to, use Claude Code, this example, Wall Street missed. And to prove that Wall Street missed it, that's why you have such a big move in this stock. So as a retail investor, finding those nuances that aren't priced into the market because they're not on the front page of the Wall Street Journal, or they're not discussed you know, in depth or detail on Bloomberg. That kind of stuff, that's how you make your money. And you have to find future opportunities like that. And it's really difficult sometimes. But as an individual investor, if you could train your brain to find or identify those opportunities, you can make a lot of money. And like one of the things that I've been noodling on going forward is that, like, you know, the next phase, like we're in the inferencing agentic AI phase. Well, eventually the robotic phase is going to come, and so I'm very focused at like getting my mind ready for like opportunities that pop up there, because you know you're going to have all sorts of opportunities of things that we can invest in as we move forward towards that point. This is just the beginning. Somebody was on CNBC today, they said something interesting, that we've been in the information age for the past 40 or 50 years, like ever since, you know, the 60s or whatever, and we're now entering a new age called the intelligence age. So you had the industrial age that started in the 1760s, and that went from the rest of the 1700s into the 1800s into the early 1900s, and then in the mid 1900s, with the advent of the atom bomb, we created the transistor, and we went into the information age. And that has been around for 50, 60, 70 years or whatever. Now we're going into the intelligence age. And I think we're just at the beginning of this, and the opportunities that are going to come are huge. You know, I think you could have a Fortune 500 company in the future that has 5 or 10 employees, and they run it out of their parents' basement because they have 100 or 200 different AI employees or thousands of AI employees that run themselves. And you could have like 1,000 of these companies, and we're all using their products and services. So, I mean, what's going to come is really going to be, I think, really cool, and I'm very optimistic, and I think there's going to be tons of jobs that we haven't even thought of yet that are going to be very prevalent in society. And I think the doomsdayers just need to shut the hell up. I'm sick and tired of hearing them talk about how the markets are going to crash and all jobs will be lost and we're all going to go to hell and blah, 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 blah. Just stay positive and have a positive mindset, you know, because it's not just further evolution in technology. We're in a race now against China. We're in a new Cold War. So that's, yes, we're also entering, we're entering the intelligence age, but we're also, just like we entered the information age and we went into the Cold War with Russia, we're in the intelligence age, but we're also entering, or at the beginning of, the second Cold War with China. And different, like when you have a Cold War, you had hot wars pop up, like the Vietnam War, the Korean War, other events like the, you know, I'm trying to think, you know, you had hot wars like the war in Iraq, the Gulf War and stuff like that, and instances like that. But you know, like terrorism, stuff like that. But you, for the most part, have this Cold War where countries are developing technology to try to outsmart themselves, and things are going on. And this, you know, we have a lot of stuff that's kind of similar to the first Cold War. You know, we have a space race going on. Okay, we made it to, we went around the moon this year. We're trying to get back to the moon and then get to Mars. That's part of the Cold War space race. China wants to do it too. So, you know, all this is going on. So, you know, I think there's lots of opportunity to come, because I don't think a lot of people understand this, but looking out 10, 20, 30, 40 years, we have to beat China. Because as time goes by, And you can look back at history, like history will look back at this period, and they will say that COVID was probably the beginning, like the main event that separated the information age at the beginning of the Cold War, Second Cold War, and the beginning of this AI AI age that we are living in. So, going forward, taking a look at AMD, there's going to be tons of opportunities like this going forward. So you have to keep a positive mind and keep a ready mind, and open mind, and a positive outlook, looking for these opportunities. And you're going to miss a bunch of them, but if you have that proper mindset, you can make money finding good opportunities. And what I was going to say is this move that we see in AMD, this move that we see in Intel, these moves happen. These moves happen because the Wall Street elites, with their wax teeth and custom suits and toupees, miss these theses. And if you as an investor just doing your homework and getting ideas, whether it be social media or podcast or whatever, find those opportunities and latch onto them, you can make a lot of money going forward. And I don't think they fully understand what's happening in the world today. They don't understand that we're in a second Cold War. We don't understand that you have this, this new age of AI, and it's going to change everything. And they're focused on stuff that's been going on for the past 25 years that's kind of playing out, like the populism that's happening. I think you just have to keep a positive outlook on everything. So let's take this move here in Intel. This is them missing that. The reason why this stock is moving like this is that their algos, their models, missed this big pop in earnings from buying computers to vibe code, and now it has to. The models have to price all this in, and then that tells their algos to buy it. That's another interesting thing that I learned from going to that seminar, is that they don't personally put on the trades. They have analysts, they have traders, and they also have algos that do stuff for them. They spend a lot of their time schmoozing and boozing clients, going to strip clubs, getting custom suits made, waxing their teeth, getting pedicures and manicures, crazy stuff like that. They live in a whole different world. They're sweet, nice people, but their heads are their egos are so big. And I wasn't offended. I like people that make a lot of money and are in that Wall Street, bubble. I like kind of pricking their bubbles a little bit. Telling them, well, I get 20-25% returns. And the guy's like looking at me, really? How does that happen? I'm like, talk to my advisor, my representative there. He'll confirm that I'm not lying. And the guy's like, his eyes were darting back and forth. I love doing that shit. I love messing with them. That's how I get off. I can live on wearing $80 shoes and not having a car and just sitting in front of screens all day, listening to podcasts, because I don't want to miss the next AMD or Intel move. Okay, I screwed up. Now I got other stuff. I got the memory move and Micron and stuff like that. But that's why you can't get everything, because you put all your money in one idea and another idea pops up and you're focused on the other idea. So even individuals, we can't get everything. We're gonna miss stuff. But all you need is to find one good thing or one good opportunity and pile your money into it, and it plays out and you'll make tons of money. And there'll be another opportunity and another opportunity. So let's take a look at the golden goose, the stock that everybody talks about, NVIDIA. It is getting up above this key level here, this previous swing high of the 211 level. We busted above it and pulled back to the 20-day, and now we're back above it, testing this swing high from last week. We are in a emerging breakout phase for NVIDIA. We just need to keep going up. We need to keep going up and get a clean breakout to the upside, which we have not gotten yet. Take a look at the oscillators here. You know, we basically, on the daily chart, we made a high here, pulled back, and you know, we're moving up in the rate of change in the fast line, but we need to get a thrust higher in the rate of change and the fast line. We need to make new highs in the rate of change above here, above these previous highs, and we need to get above, you know, back up towards these levels, closer to 10 on the fast line. And we need this slow line here to turn up. Now we look at the weekly, very good sign, okay, for NVIDIA. We maximize this rate of change up at highs, very nice. Fast line up at highs, and the slow line, it has been going down for months. We got into the negative, and we're now turning back into the positive, and that is very constructive for me. That basically says that this consolidation period that we have been in for multiple months has or is completing its course, as the slow line is now turning up and is positive. So the way that slow line is turning up and is positive, and the way the fast line is up, and the rate of change is up, what that tells me is that ultimately we should get another move up in the slow line and another thrust up in the fast line. We should get a move up and higher in NVIDIA. It's trying to break out here. It's trying to break out. I'm going to look at another chart setup here. I want to take a look at the volume. So let's take a look at, hold on, let me look and see. Hold on, everyone. I'm going to bring this up for you guys. I want to show you this chart setup. So this is basically the rate of the relative strength index, and the relative strength index with volume, and we have nice volume push up, big move up in the stock, and a nice push up in volume over the past 2 trading sessions, which is good. We're almost done with the trading today, and the volume's a little low, so we need another up day, thrust higher, and we need another day of decent volume like these previous days that we've had. So we get all that, and I think NVIDIA is constructive. I think it can go higher, but we need more up days higher. We need a clean breakout to the upside, basically, in NVIDIA. That being said, I am long calls. I want to get in before the move higher. I don't want to wait for the volume to come in and a big up move higher and a clean breakout to get in. I want to get in before that. So I am long the May 215 calls in NVIDIA. They're up slightly, about 5%, but I am long in those calls, and I'm holding them into next week. We are getting close to the closing bell. We've got about 8 minutes left into the closing bell, and yeah, we got less than 7 minutes now until the closing bell. So I am looking at my other charts, my other screens here, and let's see. Of all the stocks that we talked about, SanDisk, Micron, NVIDIA, Tesla, I do like how money is, as we go into the end of the day, the stocks that pop up, and this is just, I look at like before the close of the day. I look at all my positions to make sure I'm not going to get assigned anything. Everything looks good right now. I'm looking at those positions. And with 5 minutes left, I'm looking at the intraday charts, and I love how money is moving up in Apple. It's getting bought at the end of the day. That's very bullish for Apple. It's also getting bought in SanDisk. It's getting bought as we go into the closing bell. It's very bullish. And also in Micron. What I do not like, kind of makes it, it's not bearish, but I don't like it, is I don't like how NVIDIA hasn't moved up to test 217 or 218. I don't like how it's at 250. The money's moving into Micron, the money's moving into SanDisk. Let's take a look. One stock that let me see here. Bloom Energy, it's up today, but see how it's selling off as we go into the closing bell? And we pointed out earlier the momentum in Bloom Energy is peaking, and you can see it how it's falling. It's not getting bought as we go into the closing bell. It's showing up there. So I would buy calls for Micron and SanDisk tomorrow for Monday. That would be my bet. With all that said, we got about 4 minutes left into the closing bell. Go back to taking a look at Micron. I love that move. And let's see here. SanDisk, big move up. Also Marvell, interesting. So this stock is getting a little pop higher as we head into the closing bell. Let's take a look at the daily chart on Marvell. Nice big move, but as you can see here, we've gotten a drop in momentum, and the slow line is declining. So it's not looking too good. That's basically, you have a bona fide uptrend, and you see it in the weekly chart, you see it in the daily chart, but you see this, we're not making new highs, but we're still going higher, and we're getting a loss in momentum. So basically it means that the up move is kind of teetering out. It's teetering out. So it means we could still go higher. We're probably being up today like we are. That's a good sign and all, but momentum is not preceding price to the upside. So be careful. And another stock that I like, Corning. We're getting nice big up thrust in the rate of change, testing, getting close to highs in the fast line, and the slow line has completed its down cycle, gotten to the negative, and is now starting to move up. So all that is very bullish for Corning, and Corning has a fantastic business, man. They're making fiber optics for data centers, and there's not enough copper to run these cables in data centers, and they've figured out that they need light fiber optics. They need light to move information because they're just running out of data. So Corning I love this stock. It's up, and I like how it's at the upper Keltner channel there and continue up. I actually, I have looked at Bollinger Bands in the past, but I like Keltner channels. It uses a different calculation. It doesn't look at volatility options. It doesn't look at delta of options. It looks at average true range. It's backward looking, which is not good necessarily, but that's how charts are. And it is it's smoother. It's smoother. It just looks nicer. So I'll go back and forth and look at both. I am using Bollinger Bands on the weekly, but daily I'm using Keltner channels right now. and we're getting very close to the closing bell. We have about 1 minute, and Tesla's looking good. Intraday on Tesla, running up into the closing bell. That's a good sign. So I mentioned that's good for next week. Tesla, Micron, SanDisk, and Apple stick out to me. There's a little bit of a bid in NVIDIA, but not what I want to see. Not what I want to see. I would like to see higher, more of a bid up in NVIDIA, and we need to see that big follow through day. We need to see a follow through on high volume that basically completes this breakout to the upside. It's trying to break out, but it just needs to get above this level of 216, 217, and get to 220 and have a nice upstand, follow through to the upside. We just haven't gotten it. And with that, everyone, we're almost at the closing bell, and that is it. It is 4 p.m. and the week is over, everyone, and I will talk to you all later. Take care, everyone, and I will talk to you all later, everyone. Take care. Bye-bye.